Warren Buffett, the poster boy of free market capitalism, is actually its exact opposite. He is living proof that you can only make money if you don't believe in free markets. No, this is not some rant against Buffett. Oh, look how evil he is. No. Buffett made his money fair and square, following the real rules of the game of capitalist competition, not the poppycock students read in economics textbooks. He went against the three key things that are sold to us as part of the fairy tale called mainstream economics. First, the founding myth of mainstream economics, which is that the idea that markets are efficient, that information travels at the speed of lightning across the economy, everyone gets it at the same time, and somehow supply and demand match up very quickly. The second myth, that competition in capitalism makes it almost impossible for any single business to dominate or make excessive profits for long. This is obviously the most ridiculous claim, continuously repeated in textbooks. We all know from our own experience that this is absolutely untrue. We are surrounded by monopolies. The third myth, the claim that free market capitalism gives equal opportunity to all. Rich or poor, humble or highborn, college educated or high school dropout, all you need is talent and hard work to succeed in a capitalist economy. Buffett didn't believe any of these, and that is how he became one of the richest men in the world. I will prove this to you using a few examples and stories from Buffett's life and his investment philosophy. Each has to do with one of the three M's that determine Buffett's incredible success as an investor. Market irrationality, second monopoly, and third money power. But before I proceed, a quick appeal. 80% of you who watch my videos aren't subscribed, which means that not all my videos will reach your watch page. It is going to be a bit of a hit or miss. Now, if you like my videos and want to watch them, do subscribe so that you get to know as soon as I publish something new. Let's get back to Warren Buffett. All right, and the first of the three M's that I spoke about, market irrationality. Buffett's entire investment philosophy is ultimately based on this, that markets are never efficient, at least in the short run. And that is precisely what opens up opportunities to make money from stocks. Buffett has a nice name for this, Mr. Market, who is almost bipolar. At times he's euphoric and confident that he can charge very high prices for the shares he's selling, and the people he sells to are equally irrational. They get infected by his false optimism and rush to hand over their money to Mr. Market. Then, suddenly, Mr. Market gets depressed and anxious. That's when he cuts all stock prices. But the buyers get scared by his despair and turn their back on him. At that moment, when Mr. Market is desperately looking for buyers, Buffett steps in and buys up shares at a big discount to their actual value. The most famous instance when he got shares at bargain basement prices because the markets had irrationally marked down a stock was the case of American Express. It happened during the so-called salad oil or soybean oil scandal way back in 1963. A con man called Tino De Angelis had secured big contract from the USA's Food for Peace program to supply soybean oil. He realized that he could get big loans from banks by offering his soybean oil inventory as collateral. So he bought an old petroleum storage center in New Jersey, which had massive 50-foot storage tanks, and filled them up with seawater. A thin layer of soybean oil was actually then poured on top, and since oil floats on water, a cursory look from the top would make one believe that all of it was actually soybean oil. It was the job of inspectors from American Express Warehousing, which was a subsidiary of American Express, to verify whether De Angelis actually had the oil. As it turns out, the inspectors suspected nothing and were completely fooled. And De Angelis was able to get huge loans. By the time De Angelis was caught, his bad debts had become so massive that he took down 16 banks with him, including another American Express subsidiary. American Express shares tanked from roughly $65 in October 1963 to about $37 in January 1964, down 43%. Buffett believed this was a typical irrational overreaction by the markets, and he bought American Express shares worth $13 million, ending up with almost 5% of the company back then. Buying at a time when everyone else was selling went against the very idea of efficient markets. Buffett has done this over and over again with most of his purchases, buying mostly when the markets were punishing good companies irrationally. Market irrationality is the secret behind the massive gains he made on these stocks. But do note that Buffett does not buy shares of small companies. He almost always bets on monopolies or oligopolies with significant market share. His belief that monopolies are the best businesses to invest in is best exemplified in his own bet on the Buffalo Evening News, which he bought in 1977 for $33 million. Back then, Buffalo had two main papers, the News that Buffett owned and the Morning Courier Express, which was its main rival. The Buffalo Evening News used to come out on weekdays and Saturdays, and the Morning Courier Express was published on weekday mornings and on Sundays. The first thing Buffett did was to come out with a Sunday edition of his paper, and he decided to give it away for free for the first 5 weeks and then at a very low rate for the remainder of the time. He was accused of monopolistic predatory pricing, where a company sells a product at a very low price or gives it away for free to price competitors out of the market. In November 1977, a judge at a district court declared that the price cuts made by Buffett showed that the true intention was monopolistic. The Wall Street Journal had reported that time that Buffett had told an acquaintance that owning a monopoly newspaper was like owning an unregulated toll bridge. You could charge whatever you wanted, since there was no other way to cross over to the other side. Buffett denied ever having said exactly those words, but he did admit that he believed that owning a monopoly newspaper would be a great business in a smaller town. Buffett would later win the case on appeal, and his paper would end up becoming the main newspaper in Buffalo. Over the years, Buffett must have realized that the word monopoly doesn't sound very nice, right? So he came up with a more innocuous term for it. He called it a moat, like the deep channel of water that surrounded medieval castles, stopping enemy soldiers from crossing over. Buffett has said many times that he only invests in companies that have such a moat around them that other competitors cannot penetrate. It is just a euphemism for monopoly power, maybe because of brand strength and recognition or regulatory advantage, or maybe just having deep pockets, which helps a company cut prices temporarily and forces financially weaker competitors out of the business, just as Buffett had done with the Buffalo Evening News. A look at the equity portfolio of Berkshire Hathaway, Buffett's company, will prove my point. As of the end of September 2025, his biggest bet is on Apple, which is roughly 24% of his equities portfolio. The next two are American Express and Bank of America, which jointly account for more than 30%. Fourth comes Coca-Cola, about 10.7%, and fifth is Chevron with another 6.7%. Together, the top five make up about 70% of his portfolio, and the top 10 account for 88%. And these names include big names like Moody's, Kraft Heinz, and Alphabet, which is the parent of Google. Now, the remaining 12% is also divided among the biggest names of business: Amazon, Domino's, MasterCard, Eli Lilly, Diageo, and so on. Now, you could say that all these companies are what they are because of the exceptional talent of their owners and managers. Buffett would completely disagree with you, by the way, as he famously joked in a conversation with Bill Gates once that he invests in companies that are so good that even a ham sandwich could run them. Buffett would call all of these companies with competitive moats. Forgive me if I call them monopolies and oligopolies. Same difference. This brings me to the third major theme of Buffett's investment business: money power. There are two ways in which money power matters to Buffett. The first, of course, is in the standard, straightforward way that those who have a lot of capital have the ability to set prices and influence the marketplace. A second, more fundamental meaning of money power in Buffett's case is the ability to raise funds at a cost that is much lower than what the average Joe would have to pay. For instance, if you had to choose between investing in stocks or putting your money in an FD, you might think that choosing stocks is a better option, better returns. But that would mean losing out on a safe 6% return. That is your opportunity cost. On the other hand, if you were to take a loan to invest in stocks, you would have to pay interest on it. So the interest cost would have to be deducted from any gain you make on the markets. Both of these are your effective cost of capital, the cost of your investments. Warren Buffett starts off with an advantage over you. He has a negative cost of capital. And that is because he owns an insurance company, Geico. Let's break this down a little bit because it's a little complicated. Now, the logic of the insurance business is based on the fact that people pay premiums to protect themselves from the cost of dealing with misfortune and mishaps. For instance, you might buy accident insurance, but you really don't want to be in an accident. We pay life insurance premium, hoping that our family won't need that insurance payout pretty soon because that would mean we are dead. We pay medical insurance premiums every year, but we pray that we don't need it. Insurance companies, therefore, effectively get paid to hold other people's money. If they were a bank, they would have to pay out regular interest. An insurance float only reduces when there's a mishap, illness or death, when some payment has to be made. For the rest of the time, the insurance company keeps all the money and can reinvest it virtually for free. An insurance float, therefore, generates a negative cost of capital. Even if an insurance company gets zero return on the investment, they're still earning a notional return because they're not paying any interest on it. That is exactly what Buffett does with Geico's float. He invests it and generates huge returns for his investors thanks to an effective negative cost of capital. The people who buy the insurance policies get the insurance paid out, but they don't get anything extra out of it. Their money effectively enriches Berkshire's investors. Now, in the fairy tale world of mainstream economics, everyone is supposed to have equal access to funds, right? If they have a great idea, investors will rush to give them money in exchange for shares, or they could go to a bank and borrow like anyone else. Of course, this is utter rubbish. Investors like Buffett himself give money to those who already have money. And banks give loans to those who already have successful businesses because they are most likely to pay back their loans. But even if it were a level playing field, an ordinary entrepreneur cannot compete with the Buffetts of the world who literally have an immense pool of money with a negative cost of capital. The insurance float they control. It is a clear example that the markets are skewed in favor of those who already have capital. But the super rich and the oligarchs don't just gain from the inevitable inner workings of capitalism. They also gain because of their clout, their heft. Buffett is a prime example of this. He has repeatedly used his reputation to get sweetheart deals, not only from companies, but also from the US government. For instance, the great terms he got on Goldman Sachs shares when the US Fed wanted him to bail it out during the 2008 global financial crisis. He not only got the right to buy Goldman shares at a very low price, but he also negotiated a 10% annual dividend payout on his investments at a time when interest rates were near zero. In each case, Buffett has made money by understanding that capitalism is not a game of equals. It is heavily tilted towards owners of capital. First, the rich nations, and then the rich within those nations. In fact, Buffett himself has acknowledged that. He says that we live in an unfair society where those who win what he calls the ovarian lottery of being born in the right country, in the right gender, and into the right family end up with an unfair advantage. So as I said right at the beginning, this is not some anti-Buffett rant. In fact, I'm a great admirer of his investment philosophy and have personally learnt a lot by reading his annual letters to investors. My objective here is to simply expose the truth behind his success, lay bare what he knows about how capitalism really works versus what you are told to believe. And also, it is an attempt to see people like Buffett as what they really are, instead of worshipping them as great heroes of the contemporary world. What do you think about Buffett? Let me know in the comments whether you agree with me, and even more if you disagree. Civil, convivial disputations help us question received wisdom. And that is the objective of this channel, to raise questions in these times of unprecedented uncertainty. Because de omnibus dubitandum, we must doubt everything. Thanks for watching. Until next time, goodbye.